Hey everybody, today we are going to talk about confluence of indicators as well as zones on the chart. So confluence is essentially a term that really outlines multiple market participants all seeing the same thing, even though they're using different indicators or price levels or whatever they're using. So what I'm going to do is I'm going to go over this chart right here. This is the micros on the weekly chart, and this is something that you can use on any time frame. But this is a really good example here on the weekly time frame in early October when I'm doing this video. So if you're looking at this chart without anything on it, you'd probably be wondering, why did price bounce here? And the reason is confluence of different market participants all seeing the same thing, and that is essentially a potential support zone. So this is when we will bring in the SMA. We'll use the 40-week SMA, which is essentially the 200-day SMA, which a lot of market participants watch. We'll be using the anchored VWAP from the most recent pivot. We'll be using diagonal trend zones as well as horizontal trend zones to identify why this was likely a bounce area. So as I mentioned, most people are not using all of these particular indicators. Most people are using one or two indicators, and that's fine because it helps reduce the noise. However, even if you aren't using an indicator, you still want to at least understand how popular that indicator is, or maybe if you're not using it, other market participants that are using it, what are they seeing? Because at the end of the day, confluence and different indicators make the market. So the first variable here is in this confluence equation is the SMA 40. The 40-week SMA is essentially the 200-day simple moving average. So instead of using the 200-week, because that wouldn't give us a good indication of what the 200-day was looking like, we're using the 40-week to essentially mimic the 200-day moving average. And you can see here, this is the first area that people were definitely watching. You can see that we undercut this a little bit, but for the most part, we bounced very hard after slightly undercutting this. So this is the first variable, people who are using simple moving averages in their analysis. Well, some people may be using the anchored VWAP. The anchored VWAP is an extremely powerful indicator, and we've done videos on this, so if you are interested in learning more about the anchored VWAP is essentially anchoring, i.e. starting the VWAP from a specific point in time. And generally, you want to anchor a VWAP from important pivots in the market, reversals, all-time highs, year to date, gap ups, gap downs. But in this case, we're going to use this reversal here that we saw in March. And that is where we're going to anchor the VWAP, because as you'll see, this is where price respected this indicator multiple times. One second. You can see price respected this indicator multiple times on the way up during the summer rally. We never broke down, we never closed below it. And you can see here that we also did not close below it once again back in September and early October of 2023. So this is your second area. This is your second type of market participant also seeing a potential reversal here. Well, now we'll go on to more of trend lines and trend zones to look at people who are looking at these types of things. First, we'll draw a diagonal trend zone here from the bottom that we saw in October of 2022, connecting it here to March of 2023 and extend it out. And as mentioned in a previous video, we want to really use not only the wick to wick, but the body to body trend line. So that's essentially the width of this trend zone is taking into account the wick to wick. We're connecting the wicks here, and then we're also connecting the bodies. And instead of just having two separate lines, now we have essentially a zone that people can look at. Well, if you look here, this is another area that price also was nearing on this potential capitulation, at least short term in the market. So you have market participants who are using moving averages like the 200-day moving average, seeing an area where we could get a bounce. You've got market participants who are using the anchored VWAP, seeing where we could get a bounce. And now you're using the trend zone here, which a lot of market participants use, as a potential bounce spot as well. So now we have a confluence of 3 different ways of looking at the market, 3 different technical indicators in the market. Well, if you look at the horizontal levels that acted as resistance back in 2022 as we were moving down, we also have April of 2022 to August, the week of August 14th of 2022 as well. And if we extend this over and we use the wick here with the body here, this is how I like to draw these zones, pretty much taking the most extreme wick and then the body here, extending this over. Now we have a 4th type of market participant seeing a potential bounce area. So you have this horizontal zone. As I mentioned in previous videos that I've gone over, highlighting zones rather than lines, this gives you some margin of error, so you're not just looking at a precise area. And once again, we have essentially this X on the chart of all of these different indicators and different ways of doing technical analysis, all kind of aligning. And that's where confluence comes from, right? That's all of these different market participants all coming together and saying, well, even though I don't use the anchored VWAP, I use the 200-day and this is a bounce spot. Maybe they use the anchored VWAP and the 200-day moving average, but they don't use diagonal trend zones or horizontal trend zones. And so the more market participants that come in and see the same thing becomes more of a self-fulfilling prophecy. And this isn't just for support, this is also resistance as well. If a lot of people are seeing, in this case, the 200-day acting as resistance, as well as this previous resistance zone from April of 2022, you also have confluence here. So the more indicators and the more technical indicators that your technical tools, that I'll call this, because technically I wouldn't call a diagonal trend zone an indicator, I'd call it a tool that you can use on the chart. The more tools on the chart that are all suggesting potential support or resistance, the higher likelihood that you're likely going to get some type of self-fulfilling prophecy play out. If all of these levels are support, you're likely going to see at least a short-term bounce because you have so many different market participants buying, but they're buying for different reasons. And so using this and really understanding multiple indicators is helpful, not because you have to use all of them, but you have to know, okay, I am seeing, let's say, the MACD. I'm seeing the anchored VWAP. I'm seeing all of these different indicators. Maybe it's the MACD is curling to the upside. Maybe the RSI is oversold. Maybe you're seeing divergence on some type of oscillator. That confluence brings in multiple market participants. If you're just using one indicator, that's fine. It's great to keep things simple on the chart, but not understanding other perspectives in the market could hurt because you are not seeing the full picture. You don't have to use these things on the chart, but understanding where these levels are can help you get an idea of where are high probability reversals occurring. And so this hopefully was a good example of showing you that you can use indicators and technical tools such as basic horizontal price levels and diagonal trend zones in conjunction with anchored VWAPs and moving averages to get a better idea of where high probability reversals will occur. And you can even do this, as I mentioned, with lower indicators as well. A lot of people use MACD, a lot of people use RSI. So if you start seeing a stock that has a MACD that looks like it's reversing to the upside, but then you have other indicators that are also potentially reversing to the upside or oversold, or you could use a MACD upside curl, meaning that the MACD line is starting to curl up towards the signal line, suggesting a potential cross to the upside. And you can use things on the upper side of the chart. So anything on the lower side of the chart is going to be called a lower indicator. It's below the price chart. And anything that's an upper indicator or an upper tool is essentially something that is interacting with price, moving averages, VWAPs, trend zones, whether they're diagonal or horizontal. So being able to use all of these together, even though not using them on the chart constantly, can really help you understand where potential reversals will occur. Hopefully this video is helpful in understanding how to use Confluence the correct way and really not having, as I mentioned, to use all of these indicators together, but at least understanding what indicators are most used in the market, because the more market participants that are seeing something using different tools in the market, the more likely that you are going to get bounces or reversals to the downside simply due to self-fulfilling prophecy. Hopefully this video was helpful, as I mentioned, for a number of reasons. If you do enjoy these videos, please like and subscribe. Many other videos will be coming out throughout the next few months, even into next year. And if you have any questions, you can always comment in the comment section below.